So today, we're going to talk about a huge economic mystery. I mean, this was a puzzle that had the smartest people totally stumped for years. And then one guy, an architect of ideas really, came along and solved it. And in doing so, he pretty much changed everything we thought we knew about saving, investing, and even what makes a company valuable.
All right, let's just jump right in. What if I told you that a core idea, something pretty much everyone took for granted about how we handle our money, was just wrong? Not just a little off, but completely contradicted by the data. Well, that's exactly what happened in the middle of the 20th century, and it created this massive puzzle that had huge implications for everything.
Okay, so here's where the plot really thickens. On one side, you've got the legend himself, John Maynard Keynes. Back in 36, he came up with this fundamental psychological law that just, well, it makes perfect sense, right? He said as a country gets richer, its people are going to save a bigger and bigger chunk of their income. You get a raise, you save more. Simple. But then along comes an economist named Simon Kuznets. In 1942, he decides to actually look at the numbers, decades of US data. And what he found was wild. It was the complete opposite. Even though incomes in the US had shot through the roof, the national savings rate had barely budged. It was just stable. How could that be? And look, this wasn't just some small academic quibble. This was a giant paradox right at the heart of macroeconomics. The theory was saying one thing, and reality was screaming something totally different. For years, economists were just stumped. And then, the breakthrough. A solution that was so elegant because it didn't just look at a single moment in time. Instead, it looked at the whole journey of our financial lives. This revolutionary idea was called the lifecycle solution. So this idea came from Franco Modigliani and his partner Richard Bromberg. They came up with the lifecycle hypothesis. And what it said was, we're not just reacting to this month's paycheck. We're actually planners. We think about our entire lives, from starting out to our peak earning years, all the way to retirement. And our goal is to smooth out our lifestyle, our consumption, across all those years. And here's how it breaks down so beautifully. When you're young, your income is probably pretty low, but you've got big expenses, right? School, maybe a house, so you borrow. Then you hit middle age. Your income is peaking. This is your prime time to save, pay down that debt, and build up a nest egg. And finally, you retire. Your income from work goes to zero, so you start to dissave. You live off the wealth that you spent all those years building. It's this really natural, intuitive arc. Now, here's the kicker. This simple idea completely changed the game. It meant a country's total savings rate wasn't really about how rich it was overall. No, it was about two things, its economic growth rate and its demographics. The mix of young people borrowing, middle-aged people saving, and older folks spending down their savings. So the theory made these incredible predictions. A country with a fast-growing economy and lots of working-age people, it's going to have a high savings rate because all those savers outnumber the dissavers. But a country that's stagnating with an aging population, you guessed it, a low savings rate. And just like that, the Keynes-Kuznets paradox vanished. It wasn't a paradox after all. Modigliani had figured it out. But Modigliani, he wasn't finished. Not even close. After basically rewriting macroeconomics, he turned his sights on another huge puzzle, but this time in the world of corporate finance. He asked what seems like a simple question, but it's one that's incredibly deep. What actually gives a company its value? Is it the stuff that makes, the factories it owns, or can you actually create value out of thin air just by playing around with the financial structure? So he teams up with Merton Miller, and together they drop this bombshell that we now call the Modigliani-Miller theorem, or MM for short. And the core idea, wow, it was a total shock to everyone. They basically said, look, if you imagine a perfect world, a perfect market, a company's value has nothing to do with how it's financed. I mean, zero. It doesn't matter if it's funded by debt or by stock or some combination. The only thing that gives a company its value is what it actually owns and how much money it can make from those assets. The formula itself looks so simple, it's almost deceptive. The value of a firm with leverage, that's debt, is exactly equal to the value of a firm with no leverage. The way you finance it, the mix of debt and stock, according to the theorem, it's irrelevant to the total value. Just think of it like this, and it's a famous analogy for a reason. It's like a pizza. The theorem says you can't make the pizza any bigger or tastier just by slicing it up differently. The value is in the pizza itself, the cheese, the sauce, the crust, not in how you cut it up for everyone at the table.
Now, I know what you're thinking. Hold on, a perfect world with no taxes, no bankruptcy? And you're absolutely right, but that is precisely the genius of what they did. Modigliani and Miller knew these perfect conditions didn't exist in the real world. See, the true brilliance here is that the theorem creates a perfect baseline. It proves that the only reason a company's financing choices matter is because of those real-world imperfections, things like taxes or the costs of going bankrupt. It gave us a map telling us exactly where to look to understand corporate finance. It became the foundation for everything that followed.
So you've got these two monumental ideas, one about how individuals save over a lifetime, and another about how companies are valued. They might seem like they're from different worlds, but they're actually connected by this single powerful vision.
At their core, both the lifecycle hypothesis and the theorem are about the same thing: people and businesses making smart, rational choices over time. Whether it's a family planning for retirement 30 years from now, or investors figuring out a company's future earnings, Modigliani showed us that so much of economics is about optimizing for the long haul.
And for this incredible body of work, for literally building a new architecture for how we see the economy, Franco Modigliani was awarded the Nobel Prize in 1985. The award citation just nailed it, recognizing him for his pioneering work on both saving and financial markets.
His impact really can't be overstated. People have called it a structural rupture. He didn't just add to the conversation, he changed it entirely. He laid down new foundations in finance, he totally reshaped macroeconomics, and his ideas are even central to how we study the economic growth of developing countries.
So, why are we talking about all this? Because this isn't just some dusty old academic theory. Modigliani's ideas have a very real, very direct impact on our financial world today. I'm talking about the money in your wallet right now.
Seriously, think about it. Anytime you hear politicians debating Social Security or pensions, they're using the life cycle model as their starting point. When a huge company decides whether to take on debt or issue new stock, you better believe they're living in the world that the theorem defined. Even big government decisions about tax cuts are shaped by his work. His architecture is literally all around us. And that kind of brings us back to where we started. Modigliani's great insight was that deep down, we're all planners, constantly looking ahead. So the question his work really leaves for all of us is a personal one. Whether you realize it or not, how much of your own financial life are you already planning based on the very ideas he discovered all those years ago?